Very good evening, everyone. Welcome to this another round of exclusive webinar session for Bajaj Finance customers. Today, we have a very special speaker, Mr. Raghav Iyengar, with us, who will be sharing his thoughts about the macros and the way ahead. We are seeing that yes, Indian market is quite volatile in the last couple of weeks, and today being a very good scenario, and I would say it's a perfect day for us to be Raghav here to share his thoughts that how US election has impacted Indian economy, what is the reason of markets going up? What is the way ahead? With the same thought, I believe there cannot be any other person better than Raghav to share his thoughts. Let me just take a couple of minutes to introduce Raghav, though he don't need any kind of introduction. He's a well-known personality in the financial services industry, but is always privileged to say few words about the Raghav. So Raghav is the CEO of 361 Asset, earlier known as IFL Asset Management. Raghav comes with a rich experience of around 3 decades in the financial services sector. Raghav strengthens 361 Assets strategic direction and growth agenda and work closely with the investment teams to enhance the organization's market presence. He is responsible for the overall business strategy, designing the product suite, and various distribution strategies, leveraging international teams to support different markets and leading discussions with the institutional investors. He's also deeply involved in risk management, compliance, and regulatory affairs. Prior to joining 361, he served as a president and chief business officer at Axis Asset Management, where he led retail and institutional sales, marketing, digital, business intelligence, public relations, and investor services. His extensive experience includes significant tenures with ICICI Prudential Asset Management and Tata Asset Management. Without taking much time, Raghav, I would request you to share your thoughts on the macros, a brief about the 361 asset AMC also, and the kind of, I would say, if you get time, you can still touch on a couple of special funds the AMC is offering with a unique investment philosophy you carry so as to have a value addition in the customer portfolio. So over to you, Raghav. Thank you so much.
Thank you so much, Mohit. Thank you very much, Team Bajaj. I was really looking forward to this presentation, Mohit. I think we had a couple of what do I call reschedulements, but I'm really happy that I'm here finally. And I
Yeah,
noticed you made a very big change. Normally you do this on a Friday, but I think today we're doing this on a Wednesday.
true.
Time slot stays the same, so let's just see how this goes. I think in my
Absolutely.
previous avatar, we used to do this quite frequently,
Yeah.
and at least I enjoyed doing it a lot. It was great fun for me because your team and your clients asked some very good questions. So I'm going to do one thing. I'm going to try and run through this. I have a small PPT.
Mm-hmm.
It's about 20-25 slides, but I'll go through it quickly so that we have enough time for
Sure.
Q&A, if that's okay with you.
Sure.
Yeah.
Sure.
Maya, can you just put the PPT up, please, if that's okay? Thank you so much. Yeah. So, like Mohit said, I think the first thing I'm going to do just quickly is just take you through our business. I think number one, we are a wholly owned subsidiary of 361 Wealth and Asset Management. We are the largest wealth management system in the country today. We consolidated assets under management more are in excess of 5 lakh crores, right? And I think that makes us pretty much amongst the top two, top three in the country today. It's a founder-led firm. I think a team of young professionals got together, built this company about 15, 16 years back.
Mm-hmm.
Not too long ago, we changed our brand from IFL Wealth, where it was popularly known. We were because we wanted to give a focus. 361, by the way, the brand is it's very interesting. The name was in fact suggested by some polls that we did through our customers. So when we asked our customers what do they think of us as a company, they said that you treat us very specially, you encircle us, you take care of all our needs. So that's how the 360 terminology, and the one is obviously the one is the customer. For me, I have
Interesting.
another customer also, which is my partner, which is very important. People like you are as important to me as obviously my friend customers. And we are now a institutional owned company. So if you look at the shareholding, we are a
Mm-hmm.
publicly listed company. We have roughly about almost about 4 to 5 billion dollars of market cap today.
Yeah.
Been one of the better performing stocks over the last, especially over the last 3 years. If you see the funds, the stocks have done really well, and
Mm-hmm.
brought up by the first slide, which is actually the most important, which was that 5 lakh crore plus under assets, right? So Bain Capital, which is one of the world's largest private equity firms, is the majority shareholder with about 24.59%. Other institutional investors, which includes a mix of foreign and domestic investors own about 45%.
Hmm.
And obviously the founders and the staff own about 15-16%. So there's a very strong, how do I call it? I mean, the biggest advantage at 360 is that, all uh, interests are aligned, whether it is the shareholder, whether it is the customer, and then more importantly, also the employee. And that's
Hmm.
how the shareholding pattern is. And of course, retail public owns about 15-16%. So it's an extremely institutional backed company. In fact, I think most our majority shareholders are actually foreign shareholders right now. Some very, very large names there. What you see when you look at league table, you will see 361 AMC with about 12,000 crores of assets. But actually, we run about close to $10 billion of assets, about 85,000 crores, which is split roughly about 50,000 crores in the listed space.
Hmm.
In the listed space, Mohit, as I said, about 12 odd is in the MF space. We have another 10 odd between AIF and PMS. We are
Hmm.
large. We are very large, significant players there, and we run what is called institutional mandates for large foreign investors, people who want to take exposure to India but do not want to go through the trouble of setting up their own AMC.
Right.
These are large, they're called segregated mandates. Very, very large firms like, MIT and University of California, Abu Dhabi Investment Authority, to name a few. And that's
Hmm.
roughly about 28,000 crores out of the 50 odd thousand. In that space, of course, on the other side is the other company, which is 360 Alternate Assets Management,
Hmm.
which basically does the unlisted business. There, I think we would be
Got it.
amongst the top players in the private equity space. We run about close to 25,000 crores of assets there. Would be leaders in the private credit space, which is a very interesting area, which maybe you and your team should consider, given what's happening to fixed income markets today, which is roughly
Right.
about 9,000 crores. And we have a real assets business, which comprises of InvITs, REITs, and some real
Hmm.
estate assets, which is roughly about 4.5 to 5,000 crores. So the firm is very large, Mohit. It's yes, many people say it's a small firm. Actually, no. I think we are leaders in three or four things, especially in the private equity space and in the
Yeah.
offshore mandate space. I think very few firms compete with us over there. Very simple. I think, like I keep telling you all the time, I think the heart or the brain of the organization is obviously the fund management team. I think we are fortunate and blessed to have a set of very dedicated people here,
Hmm.
who between these five gentlemen and there is another team of another 15 people below them. This is, I'm talking on the listed side. On the
Yeah.
unlisted side, it's headed by a similar gentleman, Samir Nath, who again has very long years of experience with possibly the largest team in the
Yeah.
country. It's about 22 people. So I think it's a
Hmm.
large. I think Anup is an old veteran in the AMC business. He was
Yeah.
with DSP BlackRock for about 20 years, and then he's been a co-founder and CIO with 361 for the last 6 odd years now. And then of
Right.
course his team members, as you can see, are again from various parts of the company.
Hmm.
Parijat was the one who joined us most recently. Parijat and Nishan. And Parijat actually comes with a more of a quant background.
Okay.
So he is but he's made into play a very interesting system. We call it investment wiki, which is
Oh.
essentially we use AI a lot to try and improve research
Hmm.
outcomes in our business, and obviously improves productivity of the analyst and
That's
allows
good.
us to cover more stocks with greater detail. It sort of just puts a massive discipline into the whole
Hmm.
process. Yeah, we follow a very interesting but very simple philosophy, and I think anybody can do this if you have the discipline. Is that on one side we put return on equity, which is at 15%, and on the other side we put return on assets, which is again 15% growth. And any company which fits both of these
Okay.
is comes and we call it a
Hmm.
secular company. If a company, for example,
Okay.
is able to do the profit, we call it a cyclical, but is not able to do the return on assets, it becomes a
Hmm.
cyclical company. Classic examples, Mohit, are things like telecom, maybe to some extent airlines, etc. They would come here.
Hmm.
They're very
Yeah.
cyclical in nature. On the other side, they are defensive companies where your return on assets is 15%, but your
Hmm.
profit growth times doesn't get to 15. So classic examples there are IT, pharma. And of course, there
True.
are an interesting thing which you'll see on the left-hand side, which a lot of people like you ask me, why do you call it a value trap? Now, value trap are
Yeah.
companies that don't fit both, but
Hmm.
there's something happening in the company, and they do find at points of time parts of our portfolio. The idea is that we're trying to look for companies and which all are moving towards a secular uptrend. So
Got
in
it.
that sense, it's an extremely bottom-up investment approach. We are not value, we are not growth, we are not quality. All those words don't make sense to us. We're very clear. Our job is to find value in all companies. And if you
I
see, for
got it.
example, the BSE 500 has almost 33% of companies in value trap. So we don't ignore any
Yeah.
company, right?
Hmm.
Quickly, I think, and now this is how the performance look. If you look at how each of those sub buckets have performed, you can see, the green and red essentially represents market rotation. So there have been periods of
Hmm.
time, for example, secular companies are the high quality companies. They've not only done too much in terms of performance in the last 3 4 years, especially post COVID. But if you go back and see maybe 2 3 years earlier, they're doing quite well. And the same logic applies to, let's say, a value trap, for example. Value traps are the last column. They've done really well. But if you go back and look at 2016, 17,
Hmm.
18 years of complete red. So it's important to have a very overall philosophy which takes into account all of this. And that's
Hmm.
where I think our advantage comes in as far as this is concerned. This is a very interesting proprietary research constructed completely in-house mode. And coming from the background you are, which is Bajaj Finserv, you will appreciate this a lot because data is your life. And
Yeah.
we've been using AI now very, very nicely for the last almost 3 years. This is completely built in-house, built with our resident team members, and our IT teams have put this
Hmm.
together. So this is not outsourced. And then the beauty of the system, like AI does, is that we keep fine-tuning it as and when we are able to get better and more quality data. So this is obviously the whole story
Interesting.
about 61 in terms of us as a company, our investment philosophy, and more
Wow.
importantly, our right to win in today's market. Right
Great.
now,
Great.
I think
Great.
that was obviously the India opportunity, which is the main reason why I was called to talk to you today. Now I'm going to go and do
Yeah.
something very basic because what I'm noticing now, especially over the last 12, 14 months, is that people have
Hmm.
forgotten basic stuff. Yeah, uh, you
Yeah.
know, everyone's very focused on the next week and the next month, and a lot of unnecessary noise
True.
has crept
True.
into the whole
Yes.
investment matter.
Yeah.
So very clearly, I think this is the most important slide for me. I mean, in the sense that if you look at where we started our life more maybe 20, 25 years back, India possibly was not even in the top 10 in terms of market capitalization,
Hmm.
right?
Hmm.
I think in a matter of maybe 8, 10 years, we have now become the fifth largest. We will become the third largest global economy sooner than later. Now we can say 2030 or 2000. There are some people are talking of 3 years. There are some people talking about 5 years.
Hmm.
But it's very simple. It will happen for two primary reasons. I think one is that at maybe in the next 4 years, or maybe in the next by 2032, the next 5 6 years, you will find that maybe one out of every six working person in the world is going to be an Indian,
Hmm.
whether we like it or not. Now it's important to figure out how we get them jobs, where we get them jobs. All that is part two. But the fact of life
Hmm.
is that a large part of the working population of the world is going to be Indian. So the same thing that we used to be upset about maybe 20 years back, in civics they used to teach us that population is a problem and etc etc. Actually, that's turning out to be a boom for us, right?
Hmm.
Number two is a lot of the other things that have happened to us as an economy in terms of digitization, in terms of usage of mobile phone, internet, etc. Those are things which were unimaginable 10 years back. But you look at it today now, most people take life for granted. I mean,
Yeah.
I have spent large parts of my evenings trying to download an email and not getting that VSNL.net connection, right? And I don't know if
Hmm.
you do it, but I do it very carefully. Today, if
So
if a movie doesn't download in 3 seconds, we start getting irritated. And
yes.
that's the mental jump that people have forgotten today, and that's all
True.
leading to the whole global comparison that I'm
Yeah.
talking about. So we are we will keep talking about growth. In fact, as we are speaking today, there's a business standard conference where governor was talking, chief economic advisor has been talking. The fact of life is that everyone is projecting a conservative 6.5 to an aggressive
Hmm.
8, right? And that's the way. And if you look at the lines, I mean, the black line on top obviously is India, but if you go down and see, the rest of the world is actually faster, is way below us. Now, why is this growth line important? Because I think through two things. I think one is there are very few large economies in the world, large, meaningful economies which are growing at 6%. China did that for a long period of time. I think they had an
Hmm.
astounding period of growth for almost 30 years where they grew at 9% CAGR. What it did, Mohit, was it
Yeah.
completely transformed the world to some extent. I think it obviously transformed China from becoming a poor, malnourished, undernourished country to what they are today, which is the second largest economy. And
Yeah.
if the numbers are to believe, they can take over the US at any point of time. Maybe in the next 15, 20 years, they could be the world's largest economy. Now,
Hmm.
this is what secular growth does to you as a country. Brings you to 7% rate of growth. We don't see it. It's very, very incremental in our life. But a lot of things that we take for granted today were really luxuries 5 6 years back. And
Hmm.
I'm not even talking about you and me. I'm talking about people down this curve. Like if you look at uh, even basic stuff like I think everybody today has a mobile phone today, a high-end mobile phone. I'm not even talking the analog stuff that we used to use 20, 15, 20 years back. I think the adoption of say 4G phones is possibly the highest, or 5G phones is the highest in the world today. Now that gives you an ecosystem suddenly which makes you export, or rather now suddenly,
Mm.
matter of 3 years, we've become Apple's biggest market, right? The same commentary which used to be on China 5 years back is actually now replaced with India today. So we are
Absolutely.
we are, we are in a solid world space, and yes, can this seven trip and become five? I doubt. But can this seven become nine? I think we'll have to work really hard as a country to get there.
Mm.
But I think there is a bit of a can-do spirit, and I think this is important to keep these two facts in mind, right? I think earlier, we were very, very vulnerable to external shocks. I mean, today there are three wars, or maybe two big wars, and many small wars
Mm.
being fought. Right? And
Yeah.
oil is whatever at 74, $75. Obviously, there is obviously that's the if you ask me today, one large omnipotent risk which always exists for India, and that's a tragedy for us as a country because in our
Mm.
75 years of independence, we've not been able to discover oil for whatever reason, right? I thought we got a great opportunity when Krishna Godavari came up, and I thought, hey, here's a story which has happened. And if you see in the last 10, 15 years, US has gone from becoming a net importer to actually a net exporter of oil, thanks to shale and other things. Right? And I'm sure those pockets of oil and gas exist in our country, but for some reason we've not been able to sort of exploit
Mm.
it to the. But if I leave that aside, our external vulnerability is extremely clear now. So if you go back and think of it, the last time we were in the fragile five, if you remember
Mm.
2013,
Yeah.
we were in the so-called fragile five economies, and that was because we hardly had a quarter of imports of foreign exchange to maintain ourselves. Right today, I think it's roughly gone to more than a year. So we are now, in that sense, much much lesser vulnerable, lesser dependent on an external shock. Now, why am I talking about all this? Because these are the possible issues that could come up, which could derail our 7-8% growth,
Mm.
and hence consequently derail stock market, etc., etc. It's all reasonably interconnected. This is a big opportunity. In fact, I think your group company does a fabulous job in this. But if you just look at the statistics, and I'm not going to go through them in detail because it's a lot, and I'm happy to share this data with you. It's in the public domain. Uh, the consumer lending opportunity more can go 15% every year for the next 10 years. Hello, sorry. Uh, the consumer lending opportunity is so large, more that even if all the large companies grow 15% CAGR every year, we will yet have a long runway of at least another 10 years for us to even come up to some developed country levels over there. So I think that's the other big, if you ask me, investment opportunity or growth opportunity in the country. This has been a big move, and if you see the line on top, the wavy line is actually the contribution of private to the overall capex. For long periods of time, I think capacity utilization was below 75%. So obviously, no large manufacturer was interested in adding capacity when their existing capacity was not being utilized. But that has changed quite fundamentally in the last 4 years, especially again post COVID. Apart from India consumption, there are a lot of commodities, a lot of products that now get exported. I mean, just to give you another crazy example, we are now starting to export defense. We yet consequently we are yet the second largest defense manufacturer importer in the world, but now we have started exporting stuff. Hi Mega, am I audible? Hello, hello, um, hello. Hi, I just want to do a quick test. Am I audible, visible? Should I relog back in? Okay, I think maybe Mohit has gone off, but yeah, let me just continue this. So I think the important thing here very clearly is that the private sector has started really now jumping up in terms of capacity utilization, and I think that's a very big thing for us because I think a lot of the Make in India initiatives, a lot of the Jan Dhan stuff, and everything which the government has been doing is now finally kicking in into the private sector. Very important for them to get in because then it gives you continuity, and obviously private capex, as far as at least utilization is concerned, is a bit more efficient than what the PSUs do or the government does anyway. So this is a continuation of the previous slide. Why has this happened? I think very clearly two things. As I said, you can see on the graph on the right hand side, capacity utilization is now beyond 75, 77%. As you can see, there was a slight fall during the COVID period, but post COVID, I think things have really jumped back up. And more importantly, I think corporate balance sheets are extremely sound today. So, what was a problem for us in 2013, to some extent 2018, when the NBFC crisis happened, is not there today at all. I think corporate debt to GDP ratio is at least at its possibly at its lowest level. Lastly, of course, I think there is enough of money to be spent, because the last ratio, which is an important ratio to figure out how much money can be spent, private capex is what they actually spend out. Operating profit is again much, much lower than the long term average over here. So I think broadly three things. I think private capex is picking up. Obviously, government is yet doing the heavy lifting. Why are they doing the heavy lifting? Because of this slide. I think GST is really, collections have been fabulous. I'm sure you've seen last month's data. We are 187,000, 1.87 lakh crores already collected. And this is now becoming seamless because it's extremely electronic, very easy to collect, very low leakage happening. Yes, you will read of the scams and some pilferages, etc. happening. But when you consider the total, that the government is now collecting almost something like close to 30 lakh crores a year, uh, and more than 35 lakh crores a year, you will have those issues. But and this is a direct fallout of the kind of efficiency of collection, and then more importantly, the increase in overall spending and the collection overall in the economy, right? So of course, there is obviously uh, not demands but requests by various parties to reduce GST. I mean, a lot of today's GST gets taxed at 28%. Any automobile, for example, more than 12 lakhs cost price goes at 28. So obviously, those are things which the government will keep tinkering with. But your overall capex cycle is really taking off because the government has really huge amount of money to spend today. Right? Lastly, I think this is an important slide because we are even today a capital deficit country. We need roughly anywhere between 30 to 35 billion dollars a year of external capital to come in and help boost our requirement, right? And that's a lot of money. One reason why that comes, why people will come in here today, is because of the fact that the currency has actually been rock steady. Yes, you will see these headlines which will say 83.80 became 84.10, frankly. But if you look at the overall scheme of things, you look at, for example, something like Turkey, which has now gone through multiple years of currency depreciation. And even in this year to date, they're down 16%. If you look at Brazil, they're down 12%. These are all large, big economies, but are suffering because of capital, of massive currency movement. And that tends to have its own repercussions because of adverse currency will lead to much higher imports, will lead to much higher inflation, then will lead to an uptick in interest rates, and that whole capex cycle and all the good things that I spoke about in the last 10-15 minutes will just actually get washed off. So I think this has been an absolute joy to see, because in my career of whatever 20-25 years, I've never seen the Indian I've never seen the Indian currency being so steady. So it's absolutely fantastically managed over there. That's the interesting. Lastly, of course, I think flows are critical. FIs have obviously tilted towards debt a little more in the last couple of years. Naturally so, because obviously the Indian debt markets were giving very, very good returns. As I said, the components of debt return are obviously the interest rate and obviously the movement in currency. Because if as an FI, I will like to measure my returns in dollars or whatever underlying currency I put it in. And if you see over the last 3 years, the currency has actually done pretty good stuff. So obviously we've been a big beneficiary of RBI opening up flows GSECs to FIs in a big way, and obviously equity is there seems to be a movement. Mohit, I think you need to go on mute. Yeah, thanks. So I think there seems to be a move. I think obviously FIs have sort of, at least October has been a bad month. Everybody knows that they were out by almost 8-10 billion dollars. But the interesting thing, and I think this is something that we should spend some time on, is that because of the second set of data below, I think Indian equity investors are in some sense really balancing out the overall FI outflow. So again, we had a spectacular outflow last month. Collect almost about 100,000 crores went out of the system. This is the second largest that I have seen in my lifetime, right? And I've seen capital markets for a really long time. I mean, the the whole 2008-9 shock, GFC shock happened because of just some 40 odd thousand crores going on. At that point of time, markets collapsed 45%, right? And then over the next 15, 16 months, ever since 22, 23, FIs have been generally steadily taking out money. People ask us, why do they take out? Actually, it's a very interesting question because FIs are brought into this whole one three letter word, right? But they are different constituents below. So, like we have a set of traders who come and do a lot of day trading, there are a lot of people who use ETFs abroad to do, allocations. And if they see, they make 4, 5, 7, 8%, they tend to take out. Number one. What we have noticed, because as I told you in the beginning of the presentation, is that the number of what we call RFPs, requests for proposals, from external large long only investors, and these are very patient investors. These are not people, they will take about a year and a half to decide to want to appoint a manager. They will decide an allocation. They'll take about a year to appoint a manager, and then once they appoint, they take their own time. They will monitor you beautifully. And so it's not a trading mentality. It's an extremely long-term view of things, and that number has actually gone up. At least I can tell you from our own experience, that number has gone up significantly in the last 9 to 10 months. Right? Everyone's coming, talking to us. Everybody's sending us, proposals, asking us for proposals, making us do what we call due diligence on our funds. We have almost every week some large foreign portfolio manager coming, visiting us. So now, obviously, that's not getting translated. You will tell me, obviously, Raghav, but the October flow was minus 10 billion or minus 11 billion. Agreed, that is a fact. But please understand that that's a mix of 4, 5 things. That's also existing, maybe large private equity funds taking out money, maybe older investors churning money, maybe trading oriented flows getting done, maybe the long short guys getting out. That's it's a whole combination that comes into it. Unfortunately, we don't have the breakup of really who's taking out what, but I can tell you that at least the good FI flows, which is a really long term patient capital that India needs, at least from our side, we are seeing a lot more requests. And what I am understanding is that Gift City is another great opportunity. A lot of people are setting up shop there. There is a fair amount of interest that's coming. So please don't get dissuaded. Don't get worried about news flow headlines, which talks about minus 10 and minus 12 billion. Please also look at the underlying, and it eventually, I think it's good if the market moves from impatient to patient hands. It's very good for our capital markets, right? Obviously, the retail story everybody knows. SIP flows hit 25,000 crores last month, in the month of September. Unimaginable, because 2020, I remember Mohit and I doing a small talk, 2020-21, and at that time we were yet in four figures. In fact, a very large partner who's a good friend told me when the COVID hit, that time we used to, as an industry, mobilize close to about 5,500 crores, and he said that 5.5 will get reduced by 50%, because SIPs are the best instrument, but also the worst instrument. Now, why are they the worst? Because it takes exactly 2 seconds for you to shut it off. Any other thing, if you want to close down, takes its own level of time and has its level of cost. SIP is the easiest thing to start, and unfortunately the easiest thing to close, but it's the best instrument, because if you can be disciplined about it, significant wealth can be created by what I call by patient capital. And there is no better way for an Indian retail investor to participate on a systematic basis than to do SIPs, right? But so just look at where we were maybe 5, 6 thousand crores, not even 5 years back, 4.5 years back, and today we're at 25,000 crores. I won't be surprised if that number just keeps going upwards, right? And it's fabulous for us, because this is really patient, good capital that the capital markets needs today, right? So I think, and of course, the bottom slide is actually more on, even more interesting. That's the number of direct investors that are coming into equity. So that's another massive area. So today, if you ask me, mutual fund customers are about 5 odd crores now, I think, unique mutual fund customers. But if you were to look at, say, demat accounts, they're almost about 12 crore demat accounts that have got opened. So I think that's all an opportunity which is waiting to come into, people like Mohit and his firm have to actually have a lot of work to do to get that. So basic education is done. People are very understand that equity makes money for you. People have understood that equity is very volatile. In fact, very interesting things happen when we see markets actually going down. My experience is that money flow actually goes up, which used to be very reverse from when I started my life 15, 20 years back. I think I would get panic calls at market, 3 taka niche gir gaya, what to do, XYZ. Today, nobody calls me, number one. Number two, end of the day, figures are actually quite good. So I think that's a credit to people like you, Mohit, and your team, because I think you've been able to educate investors well. So I think one good thing is that yes, I think you continue that financial discipline. But even today, with all the work that we all have done together, only 5 crore Indians are actually putting money into mutual funds. I won't be surprised that in the next maybe 20 years you could see that number go up 5x, yeah, very very comfortably, and maybe happen faster also. So that's the great thing about our story. So in that sense, we are slightly decoupled from what the FIs are thinking. So even if people want to come, go, take some trading bets, do that, our market will be secularly reasonably stable. In fact, I think the equity market at points of time actually resembles the debt market in terms of stability, because there's hardly any volatility on many, many days, And if you look at it, obviously the numbers look very large, 1,000 point fall, 2,000 point fall, but when you measure it against the base, it's just about a percent or 2%, which is frankly nothing, given that it's an equity instrument. 1 or 2% is something which any investor should be happily willing to accept at any point of time, right? Last big one for us, I think current account is very manageable. Yeah, we have a challenge. I think we've been, trying to do this make in India, but on the converse side, we actually even today our imports from China are practically up 60% in the last 5 years. If you ask me, that's an opportunity, because technically that whole import part of it can be substituted. Obviously, China has built a fantastic manufacturing ecosystem, very difficult to replicate it. But given what happened in COVID, I think there is a very large percentage of people who want to have a China plus one strategy. And so we are getting parts of it. I think many countries are vying for that China plus one. I think as a country, obviously, we are large, complex. We have made our mark in certain areas, but I think there's a lot of business to do here. Uh, of course, these are the two jack in the boxes, which I told you, Mohit. I think inflation and GDP both are closely linked to crude. Crude, everyone is a real jack in the box. Most people have predicted stuff and most people have got it wrong, right? It's an extremely volatile commodity to predict, because one is, I think there's a fair amount of supply thanks to the US entering the markets and Venezuela coming back, and obviously the Middle East being not seeing any significant disruption, even though there's an actual shooting war going on, not even 500 miles from the largest production base of Iran, for example, today, right? But oil has been very, very steady. But can this go up $5-10 easily? But I think we are all right, because at least till about $80 a barrel is what the government is estimating, and so far we've been well below that trend line. Where will I get worried? If it goes to 100 and stays there for some time, right? Good news for all of us is that over the next maybe 5 to 7 years, our attachment or our dependence on crude as a macro will slowly reduce. It's reduced significantly over the last 10 years that I have been talking about it. But if I, my sense is over the next 10 years, given renewals coming in, given all the other focus of the government on trying to diversify our energy sources, you will see lesser and lesser impact of crude being a really active ingredient in our economy today. Yeah. And God willing, if we are able to find suddenly so lot of oil, a kg part two or something, that will be a cherry on the cake, right? This is the demographic, and this is what I was trying to tell you, that if you look at 2050, which is not too long away, I mean, 30 years from now, hopefully, Mohit, you and I will be here doing a few of these meetings, maybe with a little more gray hair. But just look at the world and look at where we look at India in terms of population of 24 to 64, which is to some extent the working age, right? So if you look at that 31, almost hardly any of our population is in the retirement mode today. And if you look at the world population has actually started to peak out at about 8.5 9 billion. So if you look at us, maybe we'll be, my sense is over the next 30 years, we'll be possibly 20% of the world, assuming the same growth trends continue. And more importantly, we'll be maybe 20% of the working population. Now, how will these people find jobs? Where will they go? What will they do? Is a question, frankly, which I think is an interesting question. But the fact of life is that a lot of Indian labor is actually going everywhere today. Used to go to the Middle East a lot, but I don't know if you know, but a lot of Indians are actually now going into Germany. A lot of Indians are now going into surprisingly Israel, and not to do any high tech stuff. They're going to do there to do farming. So, a lot of these jobs, which frankly don't need too much of, how do I put it, education or really high technical skills, are in some sense the big story for India today. And I don't know how that will pan out 20 years later, because all these people will have deep roots into India, and eventually that flow will come back here. Now, let's assume today a lot of that NRI flow doesn't really come into equities a lot. Most of it goes into banks, goes into fixed deposits, goes into real estate a lot, goes into gold. Now, just imagine a small proportion of that coming to equity. I think things can be fairly different, fairly very, very interesting there. This is a very, very interesting slide. I don't know how many of you can see the data around this, but so when, ideally, why do we put money in stocks? We put money in stocks to compound our money, right? So I think our investment team did a very, very good study, and they figured out over a 20-year period, they looked at the number of companies in our largest index, and they looked at it over four big markets, which is India, US, China, Japan, right? And these are typically the large growth engines in terms of innovation, in terms of growth, etc. And you asked how many companies actually grew 20%. Now look at this on the right hand side. Everyone has this great, and Japan is an absolutely fabulous country. I think their level of discipline is unprecedented. I mean, if we can get to 1/20th of their discipline, I think our country will dramatically change. But look at it, there's from an economic standpoint, not a single company made it to that list. When you look at China, which is again seen to be this huge, innovation factory, especially around EVs, around solar, no company made it. Maybe 15 companies. And you look at US, hardly 20 companies made it. But look at India, 90 companies out of the BSE 500 have given that kind of return. So now I think if you look at, and if I was a foreign, and this is a slide that our investment team uses very effectively when we are talking to a large portfolio manager, especially an overseas portfolio manager. We say that, ultimately your clients are entrusting you with money to make money. By you not being in India for the last 20 years, you actually missed out on so much of opportunity, right? And I think today, given all the stuff that's happening in the country in terms of financialization, digitization, workflow, all the things that I've spoken about, yes, temporarily it looks like we are an outflow machine right now. We are seeming to be the giving away of capital. I mean, we seem to be flat on FI flows if you see over the last 7-8 months. But over a period of time, my guess is they will come back to us, right? Why is that happening? I think largely because they are worried about this. I think earnings have been a mixed bag, right? Ultimately, there is a value and there's a price to that value, correct? I think, and you look at what has happened today, I think stock markets have always had this funny equation that sometimes earnings do very well, the stock price goes nowhere, right? And there are enough companies in the quality basket I can talk about who have done nothing. I mean, the country's largest private sector bank is a classic example of it, right? I mean, they're doing well from a P&L perspective, but the stock is pretty much flat if you take it over a 3-4 year kind of a period, correct? Uh, you look at some of the better NBFCs, similar stories now. But there are many other stories where the market has given multiples to a particular stock, and many of those are actually not really showing up in terms of results. So if you look at the kind of results, I think most these kind of results I haven't seen since maybe pre-COVID. An amount of earning downgrades is almost now 50% almost of the companies are not meeting their expectations. That's a dangerous sign because at some point of time, if it happens for 2-3 quarters, the stock gets re-rated very, very quickly. So I think the important thing more for us now, and so we've done the difficult job of getting people into mutual funds or into capital markets. I think now we have to do the more difficult job of trying to get them away from being extraordinarily greedy by not seeing the rear view mirror and just trying to be ahead. And very clearly what the market and what earnings have been telling us and what valuations are telling us, if you look at the next slide on valuations very clearly, is that many companies are not able to, are not, these are the most frequent words that are being coming out, right? Missed estimates, better quarter, these are the, when you pick up earnings calls and you see these 5 or 6 words are the ones that get actually highlighted a lot. Now what is this translating into? It's just translating into a current valuation which is quite expensive. So we use price to book a lot rather than price to earnings, because price to earnings is an estimate. P is an estimate that also fluctuates a bit depending on the market mood. So if somebody were to give you a 2021 P estimate, it would have been extremely bearish, but the market delivered much better because the way we fought out of COVID was unprecedented, right? Today, if someone were to give you a P estimate, very, possibly be a bit more rosy, correct? Everyone, for example, is talking about 26 being 1300 rupees for the Nifty, right? So that automatically translates to some 17-18 times forward earnings today, which makes the market look good, but our analysts are not very clear whether 1300 will happen or not. So we found that the price to book is actually a far more a sensible denominator to use, because your book is actually nothing but the assets that you're using to get your returns, correct? I mean, your capital assets are the one that are actually being used to sweat out the earnings, and ultimately the earnings in some sense translate to your profits, right? So we found that every time the market, it stays very rarely. I mean, these are the broad blocks, and most of the time the market has been between 2 and 4. If you would look at it, typically it spent more than 85% of its time in that range, and the returns in a 5-year range after that have been double digits, right? Very less times it spent, I mean, hardly 4% less than 2 times, and you see 2 times would have happened maybe 6 times or 5 times in the last 20 years. Most recent one being the 2020 COVID crash, right? But it hardly stays there. I mean, as you can see, it just spends very little time there and then it quickly bounces off. But right now we are on the above 4. We're just even after this market correction of the last month or so, where markets have come down by about 7%. We are yet today roughly about 4, instead of 4.2 times, we're about 4.1, maybe 4.05. So we are expensive. Now, what does one do now? I think importantly, does one sit out of the market, wait for that 4 point to come to 3, wait for that big elusive correction that, hey, abhi 5,000 point girega. So for it to come to say 3.5, 3.6, market has to correct roughly about 12-13%. 12-13%, you're talking of, then you're saying roughly about 10-12,000 points on the index, maybe much more on the mid cap and the small cap, because mid cap, small cap price to books are even higher. This is the large cap what I'm talking about. This is the Sensex. If I were to look at say the mid cap 150, I think the price to book there is over 6.5 times. Just to give you an example. So if you have to come back to cheap territory, you have to wait for a really long correction, right? Alternatively, what could happen is that market could just stay flattish for some period of time and just stay in a very, very narrow trading range, right? And that will frustrate all of you as investors, as it's frustrating me, because you will not have, we are used to seeing 14, 15, 16% in a year. You could get a period of 6, 8, 9 months where you could get nothing. A worst case could be a zero return for 9, 10 months. But what that will do is that it will bring valuations back to a slightly more sensible level. And I think that's the one. So I think this is a period of accumulation. I think it's always better to accumulate, not to take very aggressive bets, because obviously valuations are not in your favor today. Unlike the large tech companies in the US, India is not doing something great to sort of improve its productivity. So when I look at earnings growth, they are all growing 13, 14, 15, 16%. No company is coming out and saying that, hey, we will do an earnings growth of 50% growth from here because we are going to use some AI, or we have some fantastic transportation technology or something like that, right? And pockets of undervaluation which existed, let's say, for example, in the PSU space, in maybe 2020, 21, have all vanished today, because those prices have all sort of corrected. And in fact, in some pockets, they're actually looking very expensive today. So there are two choices. One is you either wait for a correction, park your money in some fixed deposit, wait for a year and pray for a correction. Or the other alternative is to try and use interesting ideas like what I'm going to talk about. Like, we have this fund called a balanced hybrid fund, which is India's largest 50-50 fund, I call it, which puts about 40 to 50% in equity and the balance in high grade fixed income debt, right? Done very well. Obviously, I should not talk about performance because the last 1 year it's been a rocket, but I will talk about how it has done in the fall. So the market, BSE 200 is its basic benchmark, has fallen about 7% in this, not counting today and yesterday's rise. But if I were to look at the month of October, it's down roughly about 7%. This fund is down about 1.2%. So in some sense, it, because of the debt portion, it allows you a certain amount of capital protection. Now, interestingly, thanks to the budget this year, it's also become a great way to invest in debt instruments, because if you hold this scheme for more than 2 years from your date of investment, you get taxed at 12.5% plus whatever surcharge you have. So if you were to hold debt directly, let's say if I were to come and buy a bank FD, I would pay whatever is my tax rate, say 30%. But if I were to hold it through this fund, yes, I am putting some equity in it, but the equity is well managed. As you can see, it ranges between 40 and 50. We are not looking at 80, 90% here. It's a great place to sort of park. So it's a place where, let's say, my dad, for example, who's 80 plus, and I ask him that, hey, he asked me where to put money, and I said this is a brilliant fund to put money, because uh, you need that equity return. You don't know what's going to happen to equity. It's very, very choppy. Uh, there are just too many events happening. I think one big one just got over today, which is the US election. But even then, there are many more things happening. There's Ukraine is yet on fire, Persian Gulf is on fire. There's a possibility China will do something in Taiwan. So there's too many possibilities that are there. And many country balance sheets are not yet in absolutely great shapes like how India is today. I mean, if you go and talk about China, I can tell you their banking system is yet having a lot of problems today because they are overexposed to real estate. Real estate is yet going through a down cycle, etc., etc. But so this is a great idea to come into. I mean, it's a great asset allocation idea for people who want to try and preserve capital, but at the same time grow it, and who have a like a 3 year kind of an investment horizon, right? The other one, of course, is our classic equity funds. This is, as I said, this pivoted out from defensives. You see, this is, let's say, 361 top 30 stocks will be in this portfolio. And as you can see, the tilt is now slowly become large cap. So it's now 60% large cap and about, but we are not zero on small cap. We hit 14-15% on small cap. But we have moved our valuations from what we used to have a fairly large proportion of assets in what we call the value trap. We have cut that and actually put more of that into the defensives and into the secular sectors. So that's a good place to be in because when markets are very, very uncertain, there is a flight towards predictability. So companies which have predictable earnings, which have a good story in terms of, they've created a moat where even despite whatever is happening around us, they're able to maintain that level of uh, their expectations and their guidance. I think those are the companies that will get a slightly higher premium today, right? Then of course we have FlexiCap, which is this uses the SCDV. This is a complete technology enabled one because this is where we use our investment wiki. So we're able to add Focus plus another 20 more companies here. Just a year old but done really well in that period of time. Again, extremely nimble, moves between secular and value traps very, very quickly there, right? Uh, just about a year of performance, so I won't talk about it, but it's done really well in this period of time. I mean, I have a lot of happy investors in this fund. Again, did very well in the fall. It went much higher than the benchmark, as you can see in a 1 year basis. It's outperformed the benchmark almost by about 9%. But in the recent crash, it fell much lower than the benchmark also. So in that sense, it's a great equation. I look at funds like this very carefully for my personal portfolio. That okay, everybody tends to go up reasonably well. It could be a question of you having the right stocks at the right time and maybe getting that right momentum. But how does a fund do when it falls? I think is as important a number for me, at least personally, as compared to how it goes up. My last one, which I'm more, this is interesting for you because this is a purely quant based, momentum based fund. So somebody says, I have a 50,000 Nifty view in the next 5 years and I don't care about what's going to happen. I think this is the fund for that investor. So in that sense, we've added, as you can know, I started by saying that, hey, we are in slightly overvalued territory and you should look at hybrid. But there are a lot of investors today who say that, hey, I can handle volatility, don't worry about it. So this one, for example, has done really well again on a 3 year, just completed 3 year basis. What do we add as a management here? We fund managers only allowed to buy from the secular and the defensive bucket. They're not allowed to touch stocks from the value trap and the cyclical budget. So this is beautiful because it tends to put some level of quality around the momentum strategy. And once it does that, I think it uses an algorithm to try and select the top 35 stocks within that. So pretty much equal weight stocks, plus minus 5% to a sector. That's our risk framework. And obviously the results are there for everyone to see. But yes, this is a high risk, high return fund, Mohit. So I'm going to stop here, Mohit, and just take you back to one more last slide, which is not. I'm going to leave it on this one because I think this is the important. Sorry, yeah, just yeah. So I think this is an important slide where we should. I like to just stop my presentation here because this is where we are today, and I know that hopefully you'll give me a chance and we'll talk again maybe in 5 6 months. But this is where we currently are. And I think questions I've seen in my life, the questions come largely around this.
Certainly, certainly. Thank you so much, Raghav. I believe this is something we always expect from you. A crisp presentation, giving the view of micros, giving the view of macros, touching upon the what AMC is doing and how 361 AMC's investment philosophy is different and what
Absolutely.
kind of funds are suitable for the customer portfolio in this scenario. I believe these are the bigger questions which comes from the investors that impact of geopolitical scenario, impact of US elections, whether the definition of long term is still 5 years or it has changed or no. That is a very good question which I have received from Pankaj from our Pune branch. Um,
Excellent,
uh,
excellent
so
question.
so they are saying, do we still hold the definition of long term as a 5 years, or we should start looking at 6 months or 12 months as a long term horizon? Considering you also touched upon the same, that people are now excited about the weeks or a month's performance instead of years performance. So, any view, Raghav, for the investors per se?
But I am a little old-fashioned on this one. So
Mhm.
I think I will. There's a very senior gentleman in our industry, Prashant
Mhm.
Jain, who runs his
Yeah,
own investment firm. He's quite a legend,
yeah.
and he treats equity as if it's family jewelry.
Hmm.
So he says, and I have a similar philosophy with my life at least. But of
Yeah,
course, there are a lot of people today in the world who say that long term is a week,
yeah,
short term is an hour. And
right.
unfortunately, what that happens is that you see, I think the way to deal with such investors is very simple. And
Hmm.
I'm glad Pankaj asked that question, because I think if you make your entire portfolio thought process around a week and a day and an hour, I
Hmm.
think you will miss out on one, enjoying life. Number
Yeah,
two, enjoying the
true.
magic, enjoying the magic of compounding.
Yeah, yeah, yeah.
So I
And,
think,
and,
but having said that, I think it's very, very easy to trade. It's a good way to learn about equities, provided you manage your risk carefully. So my advice to, especially, and I'm assuming Pankaj is much younger than me, so
yeah,
I'll put a disclaimer around that. That hey, put little bit of money in your trading portfolio,
yeah,
right? Use that for what I call consumption. So if you make some money, please go ahead and enjoy yourself with it. I know some
mm,
very good friends who take holidays based on
yeah,
their trading revenue,
true.
but keep a large part of your portfolio in good long-term compounding equity assets. Now, whether it's mutual funds or direct stocks or your own stock, that's your personal choice.
Yeah,
So if you, I can't. I mean, number one, I'm in a mutual fund, so I can't do the second part as an employee. I'm not allowed to trade. The other part is, despite whatever 3 decades of experience, I don't know how to trade.
true.
I am a
Okay.
very, very lazy investor. Most of my holdings are 10-year plus,
Yeah,
right?
yeah.
Even my debt investments, Mohit, are 10-year plus.
Wow.
So I've been blessed that I keep it, and it has given me very good compounding. Uh,
Absolutely. In fact, Raghav, I let me share my experience. Even I have deleted all the apps from my mobile where
okay,
I could do the tracking of my portfolio. I do
fantastic.
invest. I am on the philosophy that invest and forget, so that I will
Correct,
not even have a look under my portfolio maybe next for 6 months or so. But
correct.
when some major events happen, then of course I check so as to do the rebalancing. But I am keeping myself away from the habit of checking the
I
portfolio
think the
daily.
one thing that I would like to add for all of you is that, yeah, if you have someone like an investment partner whom you can consult before
Yeah,
it, especially taking some large decisions,
true,
very, very
true.
important, very, very important.
Absolutely. Absolutely.
You
So
know,
in fact, we
unfortunately,
always say, yeah, please.
as a country, we are so used to going to Amazon, seeing 5 star, clicking,
Yes.
buying a
Yes.
product, but we don't do that for our own financial
Financial
uh,
investment.
investments, right? We don't see, we
We
see,
still
we
do
see
our health checkups, but we
yes,
never do our financial checkups,
yeah,
which is
which is
very much needed.
important. And I think you need a bit, so despite all the technology that you have and all the,
Yes.
DUI that is available, and
True.
I think more will come where you can, plug in your portfolio, it'll tell you your health of your portfolio, etc., etc. I think it's very
Yeah.
useful to have a good friend or a partner. I would call it a partner, any format,
Yeah.
who can just basically hold your hand in both ways. Today's world, actually, it's reverse. Most
Yeah.
partners are actually a bit cautious. They are agreeing with my thought process that valuations are a bit steep, one needs to be careful. But clients are very, very bullish.
Yes, yes. In fact, we have seen such kind of behavioral change also in the
Yes,
customers,
yes,
that
yes,
earlier when market used to crash, people used to panic and call us that, sir, what to do with the portfolio, whether to do the profit booking or exit. Now the
yes,
reverse is happening.
yes,
Customers are
yes,
calling us that market is down, tell me where to invest.
yes,
That
absolutely.
is very interesting phenomenon.
And more importantly, invest with quantity. I mean, they're not talking of,
Absolutely.
so that's a,
Absolutely.
so, but Mohit, you and I have seen these fads, right? I would call it a fad. I mean,
Yeah. Yeah.
2010 to 11, you were in Delhi for a long time. You remember the
Yeah.
real estate. Nobody
Of
was putting
course, of
money into
course.
financial. Nobody was putting money into financial assets, right?
Yes, yes, yes.
Even if markets were down, people would you would call up and the client will say, "Oh, Mohit is calling me. Let me put a lakh of rupees," where you know he can put easily 10 times that amount.
Yeah, yeah.
But today
Even we are
it's
bullish. Yeah,
it's a
please,
reverse
please.
cycle. So I think that's
Yes,
where having a partner helps a bit for everybody.
absolutely.
It's also a good temperature check to keep having, and to have an external temperature check is very very useful.
True, true. And in fact, we are bullish that the penetration in mutual fund is still not that great in
Yes.
comparison to direct equities. And I believe in years to come, it will definitely take up a different level for
Oh
sure.
yes, I am very confident about two things that I think number one, the equity cult in our country will continue to grow.
True.
Number two, I think a lot of the DI, do it yourself investor, DII,
Yes.
they
Yes.
will come in and start looking at experts to manage their money,
True.
either in the form of a mutual fund, and obviously they will be looking for partners to help them guide them where to go after that.
Yeah. Yeah.
I'm seeing a little bit of a trend there also because especially the newer generation wants to do it on their own. Uh,
Great.
we've all learned, and you when you do these things, you make a few financial mistakes, and you realize that
Yeah.
it is
Yeah.
important then to get some guidance. And I think that whole set of people
I
will
think
come in.
market is maturing now, and we are
Mature. Yeah,
seeing people having interest and reaching out to us that
yeah,
please help us reviewing our portfolio and doing the rebalancing, make the wise decision.
absolutely.
People who have just seen the cycles that yes, market is never a growing market; it will definitely be a volatile also sometimes. At that point of time, the importance comes into play, and definitely, Raghav, the speakers and experts like you, when share your thoughts with our esteemed viewers, definitely help them to make wiser decisions and to
True.
review their portfolio and to understand the market volatility at this impact. So thank you so much, Raghav, and thank you all the viewers for joining us and being here.
Sorry, I
Raghav,
couldn't
it's
add
always
much to
privilege.
the US elections
Yeah,
because I think everyone was a little worried about who's going to get elected, not elected. So, frankly, for me, this election result more has been positive because my understanding was that it will be a very, very tight election and we may not know the person who's going to become president for another 1 month, which
yeah,
would have added to more volatility because then when the world's largest economy gets into a bit of political turmoil, it
true.
creates issues everywhere. But that seems to have got resolved. And my
Yeah,
sense is that's the reason why markets are very happy today because
great.
everybody likes to have clarity. And I think
Yes,
one thing which is
yes,
clear today is Donald Trump seems to be the next president. Now, whether
true.
it's good for India, bad for India, good for company,
That's
I
a
think
different story, but at least stability seems to be, clarity seems to be there.
yes, absolutely. Yes, that's so great point.
Great.
Thank you so
No, no,
much.
thank you for touching up on this, Raghav. And thank you once again. And we'll love to welcome you once again after a couple of weeks so that you can have your own fresh thoughts in the current market scenario at that particular time.
Happy,
And
happy,
viewers
happy to
will be
happy,
excited to see you again.
happy to do
So
that.
thank you so
Happy to
much, everyone. Thank
thank
you.
you.
And wish you all a very happy Diwali and happy New Year once again.
Thank you.
And thank you so much, Raghav, and thank XT. Thanks.